All right. All right. Well, thanks again, David, for having me. It's always a pleasure. And so yeah, hey guys, today I'm going to show you how to time the markets for monthly cash flow. Okay, now the trading method that I'm about to show you does not require any sophisticated charting software or any fancy proprietary indicators. I'm just leveraging price action, okay, along with a couple of carefully selected basic indicators to help identify market trend, locate trade setups, and pinpoint exact entries and exits without any guesswork. And in a few minutes, I'll show you exactly what it is. It's funny, I was listening to, I think it was Mayhem, and I can't pronounce the other person's name. So I apologize, but they were talking about TLT, and I'm totally on the same page. And maybe we can look at that at the end here. So look at the technicals. But yeah, let's go ahead and move forward here. And first and foremost, I must remind you that trading does carry significant risk, and all information in this webinar is provided for educational purposes only and is not an offer or recommendation to trade future stocks, options, or Forex. So I just want to double check, make sure that everything's working, right? You guys let me know in the chat that you guys hear me, and obviously David heard me, so you must hear me. But everything's coming through all right. Sounds good. Thanks, Jeff. So, all right, now that legal stuff's out of the way, here's a little bit about me. Okay, I've been involved in the financial markets since 2006. And pretty much over all these years, I've made just about every mistake possible in my own trading. Okay, so I've learned what works and what doesn't. And today I'd like to show you just one simple thing that has worked extremely well. Okay, and it's also stood the test of time. And if you focus on this one thing, your trading will become more predictable and consistent. Okay, and believe me, you'll have a whole lot less stress, and trading will be a whole lot less frustrating by learning how to blend with the market instead of trying to catch falling knives or picking tops. Okay, you've all heard this before, the trend is your friend, right? So then if that's the case, then why do so many traders try and pick tops and bottoms? I know, I was there, been there. I still have to fight it sometimes. But it's so much easier to enter the market in an established trend. What I've learned by trying to pick tops and bottoms is don't fight the momentum. There are times that you can pick a top and bottom, and there are some things to keep in mind, and we will go into that when we get into the charts. But don't fight the momentum. Okay, learn how to ride the natural ebb and flow of the markets. Our goal as traders, we're not here to beat the market. Okay, we want to blend with the market, kind of like a surfer rides the waves, kind of like a surfer rides the waves, of the ocean. Okay, so how do you identify the natural ebb and flow of the market? How do you identify the trend? How do you know when a market is moving up, down, or sideways? I use a combination of price action and a couple of carefully selected indicators that helps confirm what I'm already seeing in price. Okay, you got to keep it simple. After all, most traders make trading much more difficult than it really is, and that's why they're not consistent. So keep it simple. All right. Now, what if you had clear and objective rules that allow you to make trading decisions based on proven, time-tested market principles? Do you guys think you could follow them? Because what I'm about to show you will allow you to make consistent profits and systematically build your trading account. Okay. All it really takes is 3 key principles for trading mastery. Okay. Having an understanding of the natural ebb and flow of the market, knowing how to use 3 key moving averages, and using the relative strength index, or RSI, for timing the market. All right, so let's get into it. First and foremost, you need to understand the natural ebb and flow of the market. Okay, the market is continually making higher highs and lower lows. Okay, so for example, you can see right in here, got higher high, higher low, higher high, higher low, higher high, higher low, and so forth. Then we get a reversal, right? We get a new low in here, right? We've taken out this significant low, okay? And what makes these lows, how do you know? Because in real time, you don't know this, right? In after the fact, hindsight's 2020. So how do I know that this is a significant low? When the market retests or penetrates this previous high, that's when this becomes a significant low. Okay, you know what I'm saying? So, for example, there's your significant low. Okay, this is not a significant low because the market hasn't taken it out. Now that we've taken it out, now you're looking at the lowest low in the swing. Okay, and this like the devil's kind of in the details. And then here we made a new low. So the trend is potentially, going sideways or potentially going from down up to down. All right. And then again, we got a higher low or it's a retest failure and then a new low, right? Lower high, new low, lower high, and so forth. So the market is continually making, higher highs and higher lows and lower lows and lower highs. This is important. I know it's basic, but it's important. Okay. An uptrend is defined as a series of higher new highs and higher lows. So in an uptrend, we want to focus on buying opportunities, or bullish trades, long trades only. Don't fight it and try and pick tops. Okay. Just focus on buying the market down in here. The reason why is, okay, these are your gains, right? This is your gain in here, or potentially even all the way up to here versus that. Okay. You're going to have better reward to risk trades by identifying whether or not you're in an uptrend or downtrend or sideways market and trading with the trend. Okay. Preferably on the first, second, or third pullback. Okay. That's the other thing is look for first, second, or third pullback. The first and second pullback are the best. They're going to be your highest rewarding trades. Okay. A downtrend is defined as a series of lower new lows and lower highs. So in a downtrend, we want to focus on selling opportunities, right? Or bearish trades, short trades only. Don't fight it. Don't try and pick bottoms. It's not worth it. Okay. As you can see here, let's say you nailed it. Okay. You nailed it. You bought it right in here. Okay. That's it. That's all you got. But yet, if you're focusing on shorting the market, okay, and let's say you shorted it. Here's the thing. If you're buying in here, right, you might not be exiting the trade there because you're looking for bigger gains, right? And then what happens is you miss out on the short here, which could have resulted, in a move down to this area. Okay, look at the reward here versus the reward, all the way down like that. Okay, see what I'm saying? So higher probability, lower risk trades. Okay, you want your winners to pay for your losers. That's how you achieve positive expectancy, is letting your winners pay for your losers. Okay, but as you can see, between the last two slides here, when you break it down into just, hey, swing lows, new lows, swing highs, and so forth, identifying the trend is fairly easy, right? So it's also just as easy to identify a sideways market. Okay, you just have to know what to look for. All right, look at this example. We have an uptrend. Whoops. We have an uptrend, right? Moving into a trading range or sideways market. And notice that after the highest high was put in, okay, the market made relatively equal highs and equal lows, okay, before eventually breaking down over here. And notice there's a retest and failure in here. So when you think about it, and let's work from left to right, okay. We got a higher low, new high, market pulls back. Okay, you might be thinking, well, this is pretty significant, but remember, here, let me start this over so I can spend some time on this. So the market's moving up, pulls back, and then you get a bounce. And you're thinking, okay, well, there's my swing low. Maybe, you don't know. Okay. We don't know if that's significant until it comes back up here and retests this or takes it out. Okay. Whether or not this is significant, it depends on whether or not the move up off of this level can take out, retest, or take out that high. And you can see we get another pullback. So it's not. Then we get a move up. Okay. Now at this point right here, this is significant. And that's the key. Okay. That's the key to identifying, these significant price points or swing highs and swing lows in the market. Okay. You could even say that this is significant, and it is. All right. Because the market retested, pulled back, and it launched from this area. Okay. Launching points are areas where I look to potentially participate again in the market on first test. So, but the market is making new highs, pulls back. Okay. We're just seeing some follow through in this. Now notice when the market pulls back in here, right? We've just taken out this low. So we're no longer making higher lows. Okay. So when the market traded down in here, at this point, you got to ask yourself, well, what's the trend? It's sideways to up, because we haven't really proven that it's broken down yet, but we're no longer in an uptrend. We're now in a trading range at this point. Okay. And then we get a retest of this high, right? And then it fails again. So now we're definitely, okay, if you needed more confirmation, there it is. When you get a retest here, followed by a failure off that. All right. And this is important. All these little things like that in price action is important to kind of grasp. And if you get a grasp of this, then you have a really good understanding of the natural ebb and flow of the markets. And typically, guys, what you'll see, and this is, I wasn't going to talk about this today, but I'll go ahead and mention it because we got time. Typically, what you'll see is when your market moves into a consolidation like this, okay, at this point, it's critical. Whenever you have 1, 2, 3, 1, 2, 3, this is critical, because typically from here, you can get 4 and 5, right? But typically from here, it's either going to break out to the upside or break down. Okay. So here's, for example, here's 1. Here's 1. Okay. Here's 2. Here's 2. Right. Move back up. There's 3. There's 3. Notice the market tried to break down. So now we're at a critical point. We move back up and we failed to break out on 4th. So now this is 4th test. Here's 1, 2, 3. Okay, I know we've had several tests here, but that's just kind of a minor balance inside the bigger balance. Okay, so you have a minor balance area. You got to start looking for these patterns. It's powerful stuff. You have a kind of a minor balance or consolidation inside of the bigger one. But notice the same tactics apply. You have 1 first test, 2nd test. Okay, this whole thing is a 3rd test, and here's 4th test. We will typically, here's the thing. If we don't break it on 4th, then odds are if it comes back down here and this is 4th or 5th, it's going to break it. It's like getting punched in the gut, 4th or 5th time, eventually you're going to keel over, right? So same thing here. Here's 1, here's 2. Well, this whole thing is 2. There's 3. You can see on 4th test, the market even tried to break it. It did break it. And then it came back, kind of psyched you out, and it came back. And we went sideways for another swing, and then eventually broke it on 5th test. So this is important. But notice inside that little balance area, this little balance area, we have the same pattern playing out. Look at this. 1, 2, 3, 4. 1, 2, 3, 4. Okay. So whenever you see consolidation, and it could be like that, consolidation, it could be like this, a descending triangle, an ascending triangle. It could be a pennant or symmetrical triangle. This is what the TLT is doing right now. So, yeah, whenever you have that, know that, okay, when we've tested both sides 3 times, it's about something's going to happen soon, whether it's 4th or 5th test. Usually it's 4th. And here's the thing, if it fails on 4th, especially if you've got context, then it's usually in a big move in the opposite direction. Okay. And that's what happened here was, and I'm spending a whole lot of time on this, but that's okay. This is good stuff. We failed to move higher. And this one of my main strategies is looking for the market to tell me that it has failed to do something, because my expectation is a big move in the opposite direction. And I'll give you another golden nugget here. When we break out of a consolidation pattern like this, you will typically see the breakdown. Okay, there's your consolidation. With new low 1, you'll typically see a breakdown, right? The market will come back, retest the area of the breakdown. And you can call this the kiss goodbye. And you get typically 2, if not 3 new lows. That's the expectation. So if you short this in here or flip it for long, this is your expectation. Okay, a couple new lows. All right. So it doesn't mean you can't scale out of your trades or whatever. But the thing with trading and holding on to trades longer and holding on to your winners is you have to have expectations. And these expectations that I'm talking about, like the fourth test and all that, they play out very often. I mean, it's a high probability. Okay. So, and if it doesn't, it is what it is. That's interesting. That's what stops are for. And that's why you can manage the trade. You can always step in and manage the trade. So, again, long story short, a sideways market, just, you got to know where it started. Okay. Right in here again, because we made a slightly lower low. It's relatively equal, but slightly lower low. And now, if you are going to trade in here, don't overstay your welcome. Okay. Take 2/3 of your position off up in this area on a retest of this, especially if you've had the market move up like that. Okay. Because typically what you'll see is when the market moves, when you see a sustained move, okay, let's say it came down, right? You'll typically get 1, 2, 3. When we see a sustained directional move, you'll typically see 4 swings to the upside. It's 3 to 4, anywhere between 3 and 4 swings to the upside. All right. And that, because I'm talking, Jarvis, my mini schnauzer, is in here. I think he doesn't want to miss out on the action. Whenever I start talking, he comes in here. It's like, hey, what's going on? So that's him in the background shaking, if you heard him. But anyways, a sideways market is simply made up of relatively equal highs and lows. Okay. So does that make sense, guys? Does that make sense? I know it's basic. I'm getting somewhere. So hang in there. Okay. If this seems too basic for you, I'm getting somewhere. All right. But at least now you understand, the natural ebb and flow of the markets. Okay. You see how simple it is. Don't overcomplicate it. All right. So in just a few minutes, I don't know, what is it? 10 minutes, maybe 15. You've learned some key concepts that will help you to easily identify whether the market's going up, down, or sideways. All right. But that's not all. Even though this is a very powerful method for identifying the trend, it can be a little subjective. Okay. We've talked about that. And the experience and looking at charts and starting to identify these things, it's going to help if you start, annotating your charts, and just, even if you begin with, just look at price action by itself and try to identify new highs and new lows, and then, focus on doing that in real time. But like I said, even though it's very powerful, okay, it can be subjective. That's why I like to add a second component. Okay. And it's just 3 key exponential moving averages. All right. Now, the general uses for these key moving averages, okay, are 1, identifying support in an uptrend, okay, where demand for market overwhelms supply, okay, and 2, identifying resistance in a downtrend where supply for a market overwhelms demand. There's a third bullet I didn't add on here, but we'll get into it when we get into the charts. I like to see, at least 2 out of the 3 of them kind of stacked. And what I mean by that is, take a look at this chart. What I'm looking for is, this is clearly an uptrend because I'm using the 8, 21, and 50. Okay, this is the 8, this is the 21 and 50, and see how they're stacked. The 8's above the 21, above the 50. Okay, so what I want to see is to get long. Okay, I'd like to see that. There are times when the 8 is below the 21, but as long as the 21's above the 50, like it is here, I'm looking to trade it to the long side. Okay, now there are a couple different trade ideas in here, but what I'm trying to get at, and we'll get into it when we go into exact entries, because we're going to use the RSI 2-bar for timing our entries. If you're not familiar with the RSI 2-bar, when you see it, you're going to be like, holy smokes, why didn't somebody tell me about this sooner? I know, because I went for probably I'd say about 8 years before somebody finally told me about the RSI 2-bar, and it was like it was like, oh my gosh, where was this? I mean, it was right there. It's just I never thought about a setting of 2. So, but for the most part, guys, notice how the 8, 21, and 50 EMAs, help identify support, where there are bullish or long opportunities in an uptrend. So, for example, what you're looking for is, long positions in here. Okay, and this is a daily chart. All right, we'll look at a weekly too for longer term trading, because that's what this event's all about, is longer term trading. So I'm focused on the weekly and daily charts, but I just wanted to show you, okay, like you could have taken advantage of this, and we'll go through exact trade setups here soon. But you have to know where to look to begin with. Okay, you want the market to pull back into these areas. Now there may have even been a setup in here. We'll have to look at that, and definitely in here. And you will take losing trades. There may have been a trade idea in here. I don't know. We'll have to look at, because I use 2 time frames, and we're only looking at 1. So we'll have to look at both time frames, and we'll do that. But there may have been a setup in here with a stop out, and then the next trade idea, you're long in here. Okay, but note, if that was the case, all right, again, it boils down to reward and risk. Okay, you take the trade, you get stopped out, that's your risk. Because look at your next trade. Okay, maybe even all the way up to here. All right, so that's the thing. When you're trading with context, and you're not scalping the market here and here, and you can do it. It's hard. Okay, and if you do it on, you could. It's easier on an index or something that's a little bit more stable. But if you find a stock that's soaring, I mean, some stocks go parabolic, right? So you got to be careful. So you're better off trading with the trend. Okay. So again, look for opportunities on a pullback into here. Look at this. Okay. Whether you're trading the stock, whether it's futures, whether it's Forex, whether you're trading the option, a call option on the stock, or ETF. Okay. You can, TLT. I heard him say UNH. What's the gold? GLD. What's oil? I forgot what oil is. Somebody help me out here. USO. So yeah. And then any other stock, your favorite stocks. Now with stocks, I would look at relative strength in addition to, and find those stocks that are relatively stronger than the overall market. But that's for another discussion. So, but pretty much in an uptrend, okay, look for bullish opportunities on pullbacks into these moving averages. Okay, why? Because pullbacks tend to halt at or near, these rising moving averages. All right. See, it's pretty simple here. It's nothing fancy about it. The same moving averages, okay, 8, 21, and 50 can also help identify resistance in a downtrend for potential bearish or shorting opportunities. Okay, again, notice how the pullbacks right in here, once we broke down. So for example, look at this. You have a new high, right? And on this bar right there, now this becomes a significant higher low, higher low. Okay, so that's significant now. So that's going to our significant level. Then we consolidate. Market pulls back. Okay, moves up again. It's the market, the trend is still up. Okay, the trend is still up here. It's up to sideways. All right, you get clearly a retest failure here. Okay, there's another pattern going on in there too. It's kind of a failed breakout, but we can talk about that later. But you have a retest failure in there, that's supposed to be RF. And then finally we break down. So on this day, now we've taken out this, okay, out Jarvis, go leave, off you go. So now we've taken out this higher low. And notice that on this day too, we actually have the moving averages crossing over. And now the 8 is below the 21, right? And the 21 and then crossing over too. So now you have, not only did price action take out a significant low, but you have, 2 moving averages. Well, at this point, 3 moving averages kind of stacked, where you have the 8 below the 21, below the 50. Okay. Wait for the pullback in here. And notice that the pullbacks are halting again between the 21 and 50. Okay. All right. Bullet 4321. How do you identify 8, 21, and 50? You just add it to your chart. 8's faster, so that's going to be tighter. The white one's the 8. This is the 8. That's the 21. It's a little bit slower, and this is really slow. Okay. Now the question may be, well, how do I know? Do I get in, here when it pulls back to the 21? Do I get in when it pulls back to the 8 here? Do I sell it there? How do I know to wait? Because sometimes it doesn't pull back to the 50. We'll get into that. That's where the RSI comes in. So it's kind of building on itself. So you want to understand context. You need to understand the natural ebb and flow of the markets. You need to understand that, hey, pullbacks to these moving averages is where I want to enter trades. Okay, those are my higher probability, lower risk trade ideas. Entering short here with my stop there, targeting a move down to here, right? Or even lower. And then we'll get into timing. Okay, we're not there yet. But I just want to point out that, again, pullbacks tend to halt near these moving averages in here. I know, now look here, we broke it out. Okay, but using the RSI, there's no trade in here until there. And you pretty much nailed it. You didn't nail the high, but you got in the next day. Okay, so I'll show you guys the timing on that. And on this one, you would have been entering on that bar. Okay, with your stop just above those highs right there. We're taking a little heat, but by the end of the day, the market was already in your favor. Okay, we'll get into it in the next few slides. So I just want to point out that, in a downtrend, look for bearish opportunities, okay, on pullbacks to declining 8, 21, and 50 EMAs. And keep in mind, okay, always know where you're at. So the trend was up, right? This is the first new low. Remember, we typically see 1, 2, 3, 4. So if that's the case, this is new low 1. What do we expect? We expect 1, 2, 3 more new lows. So here's 1, here's 2, there's 3. So at this point, this is actually yesterday. No, is this today? That's yesterday. So at this point, it's possible that we could base here and change trend. Okay. Given the fact that, hey, that's played out. Our expectations have played out. Do I want to sell this? No. I need to see some type of failure. Some type of clear failure in there before looking to sell that. In fact, I would rather, if the market breaks out and pulls back, I'm looking for kind of a change. Maybe at this point, I'm thinking we're going to get maybe a little bit larger correction back to the upside. I don't know. We'll see. We'll see. So, but we'll use the RSI for timing. Okay. And that's what I'm going to talk about next. So do you guys have any questions on this before I move on? And a couple of things I just want to point out, that these moving averages are very common among institutional and retail traders. So that pretty much makes them a self-fulfilling prophecy. Okay. So, and since so many traders watch and use them, all right, let's use them. Keep it simple. Okay. You don't have to overcomplicate it. This is the final component. Okay. The relative strength index, or more specifically, the 2-bar RSI. Take a look at this chart. If you waited for the market to pull back to the key moving averages here, okay, for example, let's just start over here on the far left. Okay, market made new highs. The moving averages are stacked. The 8's above the 21, above the 50. Market pulls back. Okay, this is a weekly chart. The RSI is below 20. Okay, somewhere in here is where you're going to look to enter. I haven't talked about entering the trade yet. Okay, we'll get into that in the next couple slides. We're going to use another time frame. We're going to use this as that pretty much defines our trade, but we're going to use a daily. Okay, so you can use the weekly and a daily, and we're going to enter off the daily. Okay, you always want to use an anchor chart. If you want more, if you're a more active trader, okay, you can use a daily and a 60-minute chart, for example. If you're a day trader and you want to employ this method, you can use a 30-minute chart and a 3 or 1 minute chart. Okay, so the markets are fractal. You can use this on multiple time frames. You can use this if you're just a long-term investor. You can use it on a monthly and a weekly, or a weekly and a daily, either one. You can see that this one trade, I mean, resulted, that was what, August, September, right around the end of August. I mean, that was 1, 2, 3, 4, 5-month trade. Okay. So, okay. So you'd be looking at either buying the SPY or, for example, buying call options, 5, 6 months out. I mean, you can always roll if you have buy enough time, you can always roll into another month out. So before expiration. But the idea here is to, again, wait for the market to pull back to these moving averages and for a close below the 20, okay, or at near the 20, okay. So you could have even, that's good enough. You see the rejection there? See the tails in the price, the rejection? Okay. Now, what about here? It pulls back. Are you going to enter long in there? Honestly, the meat's off the bone. I mean, you can look, remember I said about 3 or 4 pushes and then we get a bigger correction or a sustained move. 1, 2, 3, 4. Okay. You develop an eye for this if you practice at it, and you could probably see it even better on the daily chart. So are you going to look to trade that? Probably not. So, all right. And then you wait for it. Okay. So here we pulled back. Are you looking to trade this? Remember, we're going to use a daily chart. So we'll have to look at the daily chart to see if we're going to trade that. But what I'm trying to point out here is, again, the market pulling back in confluence with the RSI pulling back. Here's one here. Okay, there we go. All right. You could even look at that if you want to trade a little more aggressively. Okay, right in there. See the rejection there. And then you got a bigger pullback. I like the bigger pullbacks to the 21. And you could argue and put in your trade plan, you know what? Hey, it's got to pull back to somewhere between the 8 and 21. Okay. And if it doesn't do that, then I'm not going to trade it, for example. So, but now look at this. At this point, you've had 1, 2, 3, maybe 4 pullbacks. Okay. You got to start being cautious up in here. All right. And one thing I'm going to point out, I'm going to point it out now. typically you'll see volatility at the beginning of a trend. See the volatility, you see the big bars here? Then the bars just kind of fizzle out, right? Then you get one last push up. Do you see the volatility coming in at the end? Right here, see that volatility? So you'll typically see volatility and volume at the beginning of a trend here and at the end of a trend. Okay, so just when you think that that's the top, it's not. Okay, and I'm not just saying that because hindsight, but typically we will see volatility at the end of a trend. When the market's been moving up and up and up and up, and then you start to see it kind of getting tired and it pulls back, look for one more push up of volatility. Look at this, market's moving up and up and up and up. And you see here, the last couple swings, we had volatility come in. Okay, that's very typical. So little things like that, you want to keep in mind. So this way you're not getting in it, after the meat's off the bone, you know what I'm saying? So, and then right here, again, right? We made a new high here. So that makes these significant. There's our change in trend. Okay. Now, this is a little aggressive to sell this. The better entry would be, selling it on the pullback in here. Okay. When the RSI is overbought above 80. Okay. So the RSI setting that I'm using is a 2 with the overbought and oversold at 20 and 80. Okay. You could use 15 and 85 if you wanted to. It's like if you're looking at the daily and 60-minute charts, you can use the 15 and 85. Okay. All right. This is taking a little bit longer than I thought. So that's good that we had some extra time. So the same concept works on a monthly chart for longer term investors. Okay, here's your monthly chart, right? Look at this. Well, you don't have the moving averages stacked there. So that's not really the entry. Here it is here. Okay, that's July of 2011, the fall of 2011. And look at this. Okay, the market and if you missed it there, hey, you're a longer term investor. You can trade it there. Okay, here you start entering into positions in here. Okay, so same thing here. And keep in mind, I know it's like, yeah, but man, that's like forever between trades. Okay, so don't use the monthly and weekly. Okay, use the weekly and daily, or if that's not active enough for you, use the daily and 60-minute chart. If that's not active enough, use the daily and 30-minute chart. Okay, for your swing trades. For swing trades, usually trades that last a couple days, I like to just use the daily and 30-minute chart. So for my entries. Okay. So this is just another chart. Again, just showing you that when we pulled back in here, when the market pulls back in here, you can use the RSI to time your trades. Okay, so there's plenty of opportunities to get in here. All right, you don't have to rely on the weekly and daily. Okay, you can use the daily and 60 if you're a more active trader. Okay, because it's all everything's the same. It's just two different time frames. Okay. Now, let's look at all these principles together. Okay, so when the market is potentially changing trend, and we've already went through this, but for the most part here, you can see that again we made new highs here. We keep making higher highs, and right here on this bar, that made this because we retested and took out this high, that made this significant. Okay, so right in here is the change in trend. Wait for it to pull back. Okay, so your daily chart, you had opportunities to get in short right in here. Okay, right in there, and again all through here. Okay, but remember, I'm going to show you something in the next couple slides, so you don't get short here. You get short after the market's starting to turn. Okay, let's take a look at that. All right. And again, there's really nothing magic about this. Okay, so let's get into the next step. So you determine your exact entry point. Okay, is this helpful? You guys learning a lot here? So on the chart on the left, I've got a weekly chart. The chart on the right, I've got a daily chart. Okay, same instrument. Okay, and right here, the market's clearly we're in an uptrend. 8's above the 21, above the 50. Markets pulled back. The RSI 2 bars oversold. Okay, this bar here, or this vertical line, is this vertical line here. This is it right here. What you're waiting for is for the market to pull back to the moving averages like it did. Okay, and you'll see it pull back to the moving averages on the daily chart as well. And now what you're looking for is, again, the RSI 2 bar to trade at or below the 20 on the weekly, which it did right there. Okay, then look at the daily chart for an entry. Okay, look at your daily chart for an entry. Typically, look to enter on Monday, Tuesday, or Wednesday. Okay, don't worry about entering Thursday and Friday. Look to enter on Monday, Tuesday, or Wednesday. Okay, wait for a higher close on the daily chart, whether it be Monday, Tuesday, or Wednesday. Okay, so don't look to enter trades on Thursday and Friday. Do it on Monday, Tuesday, or Wednesday. Okay, so for example, this is Friday. This is Monday. There's your long entry right there. And even your daily's oversold. So you had both your weekly and daily oversold. Okay, so there's your trade there and your targets. Okay, we'll get into stops and targets in the next slide. Over here, okay, the market's moving up, right? You look at the weekly chart. We're still in an uptrend. Yeah, but moving average crossed over and we took out the significant low over here on the daily. Doesn't matter. We're looking at the weekly chart for our trade direction. Okay, you want to trade off the higher time frame for trade. So you're going to use this anchor chart. I call this an anchor chart for trade direction. Okay, so you'd be looking to go long. What I say? With a higher close on a Monday, Tuesday, Wednesday. Okay, well, here's Monday, here's Tuesday, where's Wednesday? There's your long entry. Now in this trade, you may have been stopped out. If you put your stop right here, you got stopped out. No big deal. Okay, a week later or 2 weeks later, right? You're going long on Tuesday right there, because here's Friday. This bar is Friday. That's this bar here. Markets pulled back. Okay, this is the problem. I've coached hundreds of students and I'm like, show me your charts. So they show me their charts and they're just looking at one chart. I'm like, well, where's the other chart? He's like, well, I don't need it. I'm like, no, you need to have an anchor chart. And from this anchor chart, you determine trade direction. This is your entry chart. Okay, this will save you and save you from a whole lot of frustration. All right, and you can see again, you've been long right in here. Same thing here, long literally on Monday. And you took a little heat, but targets were hit. Okay, here's the targets. So here's that trade out the daily. Right, long in here, you got 1 2-to-1 reward to risk. Okay, place your stop just below the week. Okay, below Mondays or Tuesdays low, whichever is lower, and look for a minimum of 2-to-1. Okay, and so as you can see here, guys, a couple of these trades easily provided you. Here's a losing trade, but like this one, 4-to-1. Okay, this one 4-to-1 reward to risk. What I typically do is if I enter long in here, and let's say I bought 300 shares, I'm going to exit 100 there, 100 there, and if I've got context, which I do, I'm going to skip this and go for 100 shares up in here. Okay. And I'll manage, you can use the 21 if you want for a trailing stop, if you want. Okay, that's usually pretty safe. When the market starts going parabolic, it should hold that 8. Okay, you can use a 13 if you want. Put a 13 EMA for trailing stop if you want. So the idea is to, again, line yourself up. Okay, wait for the weekly to tell you, okay, it's safe. and then use the daily with the RSI 2 bar for timing. Okay. And again, the key to positive expectancy is to let your winners pay for your losers. Okay. That's why 2-to-1 reward to risk is absolutely minimum. On the short side, it's just the opposite. All right. Market traded, change trends, right? This is over here somewhere. The market broke down. This is a weekly chart. Look at this. Pull back actually to the breakdown area. This is the area where the market broke down, right? See all this buying right in here. We broke down and come back and retested that. Now the RSI is overbought. Okay, it came, and this is it here, these two vertical lines, or these two vertical lines. Okay, notice each daily chart keeps moving up. So you're not selling any of this. You're selling on Wednesday right there. And if you didn't trade it there because you know the 8's above the 21, fine. Okay, you had the RSI close, you're selling it, you could sell it right there. Okay, if you missed it there, now you got all moving averages stacked. Okay, you'd have to look and see where the end of the week is, but you might be selling it right in there. Okay, so you had 3 opportunities to get in here. Okay, but again, line yourself up with the larger time frame. I can't stress that enough. All right, here's the trades. So put your stop just above that. Okay, you can look back at price action. I like to look at price action to the left. And one of the things I look for is this area right here is the breakdown area, right? See how we took out the trend line? This is the last area where it pulled back to. The high of that green bar, put your stop above that. More often than not, you're going to prevent a whipsaw. Okay, and your targets would have been easily 4-to-1, more than that to the downside. Okay, all right. So again, I've got more to talk about. So, which is good. I got about 10 more minutes I can fill up before we can, if you guys want to do a Q&A, but because I want to talk to you about something else. So hang in there. But again, that's pretty much the strategy. Keep it simple. Okay. All it takes is a good understanding of these 3 key principles for trading mastery. All right. Now, and if you liked what I just shared with you, and you're going to use it, you know, to apply in your own discretionary trading. Okay, I've got the perfect thing that will actually help you scale this. Okay, I've been working with automated systems for a few years now, and what I've personally found with automated trading is that optimizing an automated strategy for different market environments can be a challenge, and getting real-time results to match back-tested results can be a challenge. If you've messed with automated trading, you know what I'm talking about. And then also, you know, leaning on just one strategy can be a challenge. So really, I mean, all of those things that I had mentioned are challenges, okay, with respect to automated trading. So what we've got is this thing called Robot Lab. Okay, it allows you to take pretty much everything you have here that I've shown you and scale it. Okay, so you can more or less create another stream of income, right? So you have your discretionary trading, whether it's the strategy I showed you or your own strategy. Okay, or if you like somebody else's strategy, that's fine. But what I've got is something to create an extra stream of income, and it's called Robot Lab. Okay, and it allows you to scale what you're doing. Okay, so what we're offering you today is for you to come in and learn how to do it. Okay, tomorrow, Thursday, July 21st at 4:15, I'd like to invite you to a free live masterclass where you'll learn a uniquely proven way that you can use fully automated day trading systems to go from 0 to full-time trading. Okay, it's not with me, but with the guy that is actually the architect behind Robot Lab. His name is Christian, and you're gonna absolutely love him. Okay, so now, before I show you my robot portfolio, because I've got my own robot portfolio using the robots from Robot Lab, but before I show you that, I just want to give you a sneak peek of what you're going to see in Christian's live class. So it's going to be about a 90-minute presentation, and here's what Christian's going to talk about. Oh, and by the way, real quick, you're actually going to get a free robot. So if you want one, just for coming. All right. But yeah, here's what you're going to learn. All right. So Christian's going to talk about our backwardation certainty secret and what that even means. So this way you'll know what to expect from an automated trading system. And so this way you can develop trust in the system. That's so important. So this way you can also continue trading it for the long term. Okay. He'll show you how to slash risk. Risk is a huge issue. Okay. For myself and in speaking with other traders, drawdowns are huge issues, especially with automated bots. Okay. And especially if you have a small account. He'll show you how to create a portfolio of bots that minimize drawdowns and maximizes profits. In fact, in the next slide, guys, don't go anywhere because I want to show you a portfolio that I created at the end of June. I've been trading different portfolios, and this one I created at the end of June, and I was just like, I couldn't sleep that night. It's made up of 6 to 7 bots, and it minimizes drawdowns. Okay. I'm actually currently running it each day in my own live account. I've got it set up on a VPS. I enable it in the morning, check on it throughout the day, check on it at the end of the day, and then I'll disconnect and then just re-enable them in the morning. But Christian is also going to discuss with you the #1 automated day trading system mistake that traders make, and he'll show you how to avoid it. This is something that I've had to learn the hard way. And finally, he'll show you a 0 to full-time income trading action plan. So you'll learn a step-by-step plan for scaling your portfolio of bots as you build your account over time. And of course, at the end of the webinar, you'll save some time for Q&A, okay? So they can get all your questions answered, all right? I don't want to bore you with all the details here. Just sign up, come check it out, okay? Now, about that portfolio I was talking about, let me post that link in here for you guys. That would help, right? If you had the link, let me post that in here for you, okay? And then let me finish this, Dalton and Mike, and then I'll come back and answer those questions, all right? So, because I want to talk about this real quick. We still got 15 or 10, at least 10 minutes left. So I only need 5 more minutes. So now about this portfolio I was talking about, take a look at this equity curve. Okay, this is from May 6th of 2019 when the micros first started trading. Okay, that's where we have the data on NinjaTrader. It started somewhere in May. It might have been May 1st. I don't remember. Anyways, beginning of May 2019. Okay, until yesterday. Take a look at these performance metrics. Okay, look at this total net profit. This is a portfolio made up of 7 bots. Okay, look at the drawdown. This is what caught my eye. I think the trick was, and I've been building different portfolios, and I've been trying to come up with one, and I finally came up with it because we've got 45 different bots. In fact, they're introducing some crypto bots now. So you probably learn about it tomorrow in the session if you join us in the session. This is how I came up with it. Okay, this portfolio trades gold, the S&P, E-mini S&P, and the NASDAQ. And you can add a crude oil bot in there that increases the drawdown just a tad, but it increases your net profit as well. The E-mini S&P bots and the gold, and this is on a micro account. Okay, so if you're like, well, that's not a whole lot of money. That's only $1,400 a month. Honestly, most people would love to have another $1,400 a month. Okay, this is the micros. So if you trade the E-minis and the full size gold, okay, that's $14K a month. So, all right, most people don't have that, and they're just trading micros. All right, most people I talk to, they got smaller accounts, they're trading micros. Every once in a while, you talk to somebody, they got $200,000 sitting in their account. But most people, have less than 25K, and this is perfect. So you can even trade multiple. If you traded 2 contracts, that's $2,800 a month, okay, on average. So, but look at this. Its winning percentage is 57%. Okay, this is an automated system, guys. That's really good for an automated system. Look at its profit factor, and that's the key. And I think the way we got that was because the NASDAQ is more volatile. What I did was I found the NASDAQ bot with the least amount of drawdown, And then I started adding NASDAQ bots to that and trying different combinations. And then I found another NASDAQ bot that kind of does, it's like kind of a hedge. So what that did was that actually reduced by adding that other NASDAQ bot to the one that we're already trading in combination with the 2 gold bots and the 2 or 3 S&P bots. What that did was that reduced the drawdown and actually increased the profit, where the others were always increasing the drawdown with the profit. So I was able to figure out how to actually get that drawdown, and these are optimized templates, but I was able to actually figure out how to get those drawdowns minimum. So like I said, when I ran this, and when I show you the next screen, you'll see what I'm talking about. I couldn't sleep that night, and I started running it, and I'm just like, and I'll show you yesterday's results. So, but look at this monthly net profit distribution. Okay, this is the historical monthly net profit distribution of this portfolio. It shows you how it's performed. It gives you an idea of what to expect each month. Okay, look at this. Only 3 losing months out of 38. This is why I couldn't sleep. And look at, okay, there's 1, there's 2, there's 3. And look at this losing month. Okay, this is it here actually. That's your largest losing month. Okay, now, again, historical results are not necessarily indicative of future results. All right, but I'm trading this bot myself on a live account. It's working. And the real-time results, while there are some discrepancies, the real-time results are pretty close to backtest results. Okay, and again, this is on 1 micro. All right, trading 6 or 7 bots. And this is why I'm trading it in my own live account. Okay. In fact, this was yesterday, trading just 1 micro. Okay, on my 6 bot portfolio in my live account with, I had one of those in Sim. Okay. This is actually my dad and I, we funded an account, just a small account together, because he wanted to see, he had some extra money. I'm like, well, I mean, take it and we'll just run some bots and let's see what happens. This was yesterday. Okay. There isn't a date on here, is there? There isn't. But anyways, I took the screenshot, and you can see I've got it. This is my remote desktop connection up in here. I took the screenshot yesterday to show Christian, because he had reached out to me. He's like, oh, yeah, it was a great day today. He's trading full size, on a 6-figure account. So he really nailed it. But I know it's just 1 day, but here's the thing, and you will have losing days, right? But look at the results over the long run. Okay, here's a 3-year back test. And here's the thing. I also did a back test back to 2008, and it's very similar. Okay, you had some more losing months in there, but it was like 3 to 4 every 3 years. So, if you go back to 2008, you may have had, I don't know, 10 or 12 losing months, whatever. And they're small, okay, relative to the gains. So, guys, all I do is enable these strategies in the morning. It literally takes less than 5 minutes. The portfolio is off and running at its own VPS. I can log in remotely from anywhere, check to see how it's doing. And again, if this looks like something that you would like to learn more about, okay, and possibly start scaling your discretionary trading with automated trading and potentially create another income stream, another stream of income for yourself. All right. Again, I would encourage you to join us tomorrow at 4:15. Okay. I think we have a cap of 250 on the Zoom. I'm not sure. That must be it. And in fact, just for joining us, you get a free robot. Okay. So come and spend some time with us tomorrow. Now, if you're on a fence, I'll be honest, at first I was skeptical about automated trading. Okay. I'm a discretionary trader myself. I'm very technical. I love the charts. But then I started trading a few of these bots in another live account, and I started to see the results, positive results. Okay. Results that for the most part, actually matched backtest results. That's what blew me away. So now I've got a handful of bots that I turn on every morning, and I'll check on throughout the day. Okay. I'll check on them at the end of the trading day just to make sure they're flat and so forth. All right. And I like to say that they're my employees. Okay, they're doing the work for me. I just turn them on and they run with it. And keep in mind, not every day is a winner. Okay, but overall, my portfolio is making money. And so in essence, I have another stream of income that just takes a few minutes each day. So I'm sure there's people here, or some of you here that would look for or want another stream of income that literally only takes a few minutes each day, right? So if you do, and or just want to learn more about fully automated day trading systems, join us tomorrow at 4:15. So yeah, I mean, the results speak for themselves. Okay, and I see this. It blows me away, because there are bots. There are other portfolios where you'll have 3 or 4 losing months in a row, right? They might be small, but still, it's like, okay, when is this thing going to start making money again? Though with this portfolio, okay, look at this. I think when I did the back test on the full, all the way back to 2008, you may have had, I don't know, 2 losing months in a row, which were small. So no big deal. Okay. So any questions, guys? But definitely come join us tomorrow. It's free, and you get a free robot, and you'll learn about automated systems. And so yeah, do you guys have? I got a couple minutes, I guess. Do you guys have a couple questions? Mike says, please explain the RSI setting. Yeah, no worries. So back over here, again, if you're using like Thinkorswim, you set it. It's an R. The default's 14, right? Change it from 14 to 2. If you're using Ninjacators, there's like a smoothing part of it. I think the default's 3. Change it to 1. So pretty much 2 is your setting with a smoothing of 1. If there's no smoothing, then don't worry about it. Just use a setting of 2. Now you're overbought and oversold. 80 and 20. Okay. If you wanted to, like, if you're going to start day trading it or using it in smaller time frames, you might want to look at 85 and 15. Okay. All right. Does that help, Mike? The free bot can be used on trading. No, the bots are designed to be used with NinjaTrader. Okay, the bots are designed for NinjaTrader. We have plans to, I think, TradingView, to eventually get them working on TradingView. I think that's the plan. I'm not sure. I know TradeStation was in the works. So, okay, but the free bot is designed to be used with NinjaTrader. Dalton says, what average is used for the RSI? The default. The default. So I have no idea. I'd have to look it up. Here, let me look it up. Just give me a second. Indicators. Here we go. RSI 2-1. Yeah, the default. So probably Wilder's. I mean, he's the one who came up with the RSI, relative strength index. So, okay. All right. So, can't sign in online. You can't sign in online? You mean on that link? That link doesn't work? Maybe try a different browser. Click the button. Click the button to save your seat. Yeah. Okay. Jeff, link works. Sign up for tomorrow. Okay. Dalton says link worked. Okay. Yeah. No, whoops, sorry. I lost my PowerPoint. So hold on, let me refresh this. You can't click this button. You have to go to the link. So yeah, clicking that button doesn't do anything. Click on the link I posted in the chat. Okay, I'll post it in there again. So I don't want to run into anybody else's time here. We got 3 minutes left. So do you guys have anything else for me? If not, then David, it's all yours. And again, I appreciate you allowing me the opportunity to come in here and share a strategy and Robot Lab with the guys. So appreciate it.